Coming off the back of a week that's been dominated by narratives around the US, in particular with the CPI numbers really informing markets that apparently September is a foregone conclusion when it comes to rate cuts, but also a theme around UK data. This coming week provides us with a similar kind of narrative. We've got the Jackson Hole Symposium and the FOMC minutes to inform us around the Fed. We've got the UK inflation gauge coming out as well, alongside the Canadian inflation numbers. So plenty to sink our teeth into for the week starting Monday, the 18th of August. So as we always do, let's kick off with an overview on exactly what the big ticket items are according to Trading Economics. You can see here on Tuesday, inflation coming out of Canada. That's the headline number really for the day. Aside from that, we then have inflation once again on Wednesday, this time coming out of the UK, with an expectation that we see a rise once again, 4% expected now for UK inflation. Troubling times. FOMC minutes also on Wednesday. Then we've got Thursday with the PMI numbers being released across the globe, ending the day with inflation out of Japan, and closing the week with retail sales from the UK. Now, normally I kick off with the US. This time around, it's the UK because, of course, in the week just gone, we have seen a raft of key data points. Most recently, we've seen the GDP number coming in better than expected, 0.4 number for the monthly figure for June. That lifted the year-on-year figure to 0.3, but that's down from 0.7 last time around. But ultimately, it's better than expected. Also saw stronger than expected manufacturing and industrial production numbers, also exports. So by and large, they were better than expected. Of course, there's heightened fears at the moment around this black hole in the public finances that Rachel Reeves is going to have to patch up. The NIESR latest assessment said it was around 50 billion pounds. Now, part of that came down to weaker growth. So whether that higher growth figure actually provides the basis for a smaller black hole, that remains to be seen. But certainly one of the biggest problems that the UK faces is the fact that, okay, if the economy is struggling, and we've got a central bank and a government where they're trying to be aligned around the narrative of the government struggling with the huge amount of debt and the potential borrowing levels, you would think they would be cutting interest rates. They did cut interest rates. It was by a very narrow margin, 4.41, and then ultimately swung to 5.4 in the second recount. And the fact of the matter is, it doesn't look like we're going to see another cut from the BOE too quickly, and in part that's because of inflation. And we can see that here, right? 4% expected for headline inflation. The core reading also expected to rise to 3.8. If you look at the monthly figures, arguably that tells a different story, because 0.2 on both headline and core means that actually inflation is coming down a bit to more normalized levels. If we see 0.2 every month, then soon enough we'll get within the sort of mid to low twos in terms of 2% to 2.5%. But of course, we've had a few bumper months, most notably the month where we saw like 1% inflation in 1 month alone, because we saw a number of the different measures implemented by the government coming in at the same time as the price cap on energy being lifted. And all of that really sort of kicked into this massive bout of inflation in one foul swoop. But from a base effect standpoint, despite the decline expected for those monthly CPI numbers, we could see a significant rise, which points towards the figures from a year ago being lower, essentially, on monthly inflation. Aside from that, we've got retail sales on Friday, PMIs on Thursday. So really, this is a gauge on what's the direction of travel for the UK economy, and then what's the inflation picture, and to what degree will the Bank of England be hamstrung in all of this. In terms of that inflation number, you can see when we're talking about the July number coming in, if you look at July of last year, those really low figures account for why we're expecting to see a decline in monthly inflation, but a rise in terms of year-on-year inflation, that so-called base effects coming into play. But I would concentrate more on those monthly numbers. If they come back to 0.2, then, that's things sort of turning around into a better position. But certainly over the course of 2025, things have gone in the wrong direction, really. We've seen some pretty chunky inflation numbers, particularly that April reading, which have really provided the basis for the Bank of England to continue to take things very slow. And that's what the outlook is for the Bank of England, according to Refinitiv. So you can see here, September, no rate cut. November, by and large, no rate cut. December, potentially. Essentially, it's a coin toss on a rate cut by year end. And so for a central bank that has already been taking it very slow, they're going to have to continue to do exactly that as they move forward. Because of the fact that inflation is so high. So if we see elevated monthly inflation, that's really concerning, because it just means that the Bank of England is going to have to continue to take this very cautious approach. In terms of the chart for, say, cable, let's look at it, because I think it's an interesting one. You're talking about two central banks that have, I'm aware you can't see it yet, we're talking about two central banks that have both stayed very patient when it comes to cutting interest rates. And now we're getting into a position where people are very confident that the Fed is going to be ramping up easing, and the Bank of England, well, that might not be the case. And now we're coming off the back of this strong rally in terms of the pound rising into resistance. Now, of course, if we see a hawkish Bank of England and a dovish Federal Reserve, then it provides the basis for us to believe that we could see a strengthening of the pound. That's exactly what has been happening of late. You can see exactly that here, coming into the sort of 136 resistance level. We're starting to see a little bit of profit taking coming into play here. Of course, this is a key resistance level of 136, representing the swing high established back in July. And so essentially, if we break up through that level, then we look at that continuation. For the time being, yes, we could see a bit of a pullback from this resistance level just because of the sort of significance of that resistance level. How far does it go? Difficult to say, but ultimately you're looking at relatively shallow retracements in the past, right? Very shallow retracements, then just continuing on that theme. So whether we come into a sort of deeper retracement here, whether we come into a shallow retracement, that remains to be seen. Let me just get that and put it onto a sort of shallow retracement option. There we go. So we're just moving past the 23.6 at the moment. For me, you know, if we come out with strong inflation numbers, if those 0.2s are actually overcome, you know, that's particularly problematic and points towards a potential breakup through this 136 resistance level and continuation of the rebound seen for this pair. At the moment, we're seeing sort of respecting resistance, and the data we see over the course of the coming weeks should give us a lot more guidance on where we go from here. In terms of the US, we have got plenty to look at from a sort of monetary standpoint, less so in terms of the sort of headline hardcore data. I mean, look, they have got the building permits and housing starts as tier 1 or category A events. I wouldn't say that's the case personally. I don't necessarily see massive movements in terms of the markets around those events. Existing home sales, the same kind of thing, right? I would say the PMI numbers are arguably going to be much more important. And then you've got the likes of the FOMC minutes and the Jackson Hole Symposium. Now, I haven't managed to find the breakdown in terms of exactly who's speaking when, but historically, the Jackson Hole event does provide the basis for some pretty significant breakthroughs in terms of the commentary being provided by central bankers in particular. And so at this current moment, if you're going to look at a central banker to come out with a significant comment, you've got to be looking at Jay Powell. Now, traditionally, Jay Powell will appear on the first Friday of the event or the Friday of the event. But like I said, I haven't got clarity on that, so I'm not going to necessarily say that he will. There's a chance that he speaks on the Friday. Essentially, the position we're getting into now, Scott Bessent said that there's potentially 11 candidates for the job. And that to me means 11 people whose job it is to talk down the job that Powell's done and to talk up the idea that we should see a massive ramping up in terms of easing from the Federal Reserve because they're trying to get the job. So do we see some of those people speaking at the Jackson Hole event? Not sure, quite frankly. But certainly the narrative around exactly how Jerome Powell sees things, considering markets are now pricing the base case scenario of being that we cut rates 3 times in the remaining 3 meetings. Let's see exactly how he sees things. Core CPI did move a little bit higher, but we saw flatlining headline inflation, whereas markets were expecting that to rise as well. So there's a little bit for both. But certainly the jobs market has provided the potential basis for the Fed to ease, and by which degree, or what degree is Jerome Powell suddenly going to roll over into a sort of dovish stance or push back? That's going to be really important here. So an interesting week nonetheless. And you see here in terms of the sort of PMI numbers, we're expecting to see a significant drop off in the services PMI, also a bit of a move low in terms of the manufacturing PMI. So sort of weakening in terms of the US economic story, aligning with what happened with the jobs numbers, does provide the basis for the Fed to come out with a more dovish outlook. The way that I've sort of shaped this is essentially not necessarily to say, oh, if this, if I show you a chart of GDP or whatever, if that happens, then it could do this. Instead, I'm looking at it in terms of market expectations of where rates will be by year end. Essentially, because if you see weak economic data, let's say the PMI numbers come in really poor, then that's going to drive this December meeting line lower, right? So that would, by the correlation we've got up here, that would largely point towards a weakening of the US dollar. The flip side of it is what's happening in terms of equity markets. And we can see here that by and large, as it moves lower, generally we see, so as we see expectations of additional rate cuts, it is beneficial for, say, the Nasdaq as we have here. But that's not always the case, because it really depends on exactly what the showing is. If we think that the economy is about to roll over into a recession, the equity markets don't necessarily take that as a great news. If people think that the weakness in the jobs market is relatively transient in nature, and that we can look beyond that because we're seeing these trade deals coming into fruition, we're going to see rate cuts coming into fruition, that's when you can see the expectation of additional rate cuts coming hand in hand with equity market strength, which is what we're seeing at the moment. So really, the relationships between these different economic indicators or market expectations and certain markets, whether equities or US dollar or gold or whatever, those relationships will change over time. And a lot of it comes down to the reasoning behind it and the wider environment that plays out to drive down those expectations. I don't necessarily think right now there's a huge fear that the US economy is heading towards a recession. Yes, we saw some weak payrolls numbers. In actual fact, yesterday we saw commentary from a Fed member, can't remember exactly who it was, saying, well, do you know what? The payrolls often come in weak when you're essentially at full employment and they're not necessarily too much to worry about. So maybe markets are taking that approach. But at the moment, the higher expectation of rate cuts aren't necessarily driving down markets. Instead, they're driving equities towards the upside, most notably the tech sector. And that's why the Nasdaq is leading the way. So let's jump onto the Nasdaq and see exactly how things are shaping up from that perspective. This is, that's not Nasdaq. Here we go. So daily time frame, you can see very clearly, nice bull market since that low in April. You can see the latest push has taken us up through resistance here, sort of 23700 kind of area. We're pulling back at the moment, coming into both what was resistance turned into support. So horizontal support alongside this trend line support. Keep an eye out on this as a potential area that breaks. If we break through, let me just get that into a deep fib zone. If we break through this area, really we need to break the 23482 to point towards a wider retracement coming into play. Until then, this zone of support, I think, is likely to hold up. It's a question mark of whether you think that we're due a major reversal here. I think earnings season has been strong. Many of these trade deals have either been pushed back, which we've just seen 90 days for extra for China, or deals having been struck. Yes, we've got a bit of weak economic data that is driving a dovish Fed, but I don't necessarily think it's going to be very long lasting in nature per se. So short-term pullbacks in my mind are opportunities, but like I said, you've always got to be aware of at what point are you wrong in that instance, and that would be this breakthrough 23482, and in which case I'll be looking at this from a wider perspective and then saying, okay, now we're retracing this wider move here. But we're not quite there at the moment, and therefore short-term pullbacks, I think, are likely to be exactly that, short-term in nature. And finally, wrapping things up, we have got the latest in terms of inflation coming out of Canada. That comes alongside retail sales. The forecast is that we see some improvement on the retail sales picture for the final June figure. But then in terms of the preliminary July number expectation, that we dropped down into -0.4. Of course, there's major question marks around the Canadian economy at the moment. Unemployment continues to push upwards. Inflation has remained relatively subdued, and that provided the basis for the Bank of Canada to cut interest rates when others perhaps weren't able to do so. I'm looking at you, Bank of England. And so the question mark here is, like, do we continue to see the Bank of Canada cut rates? They're at 2.75 in terms of their headline interest rates, significantly below the likes of, let's say, the UK, 4%, the Federal Reserve, 4.5%. So are we going to see much more from the Bank of Canada, or have they pretty much used what they have in terms of ammunition? Now, the more troublesome part of this is the core inflation, and we can see here in terms of the light blue line, core inflation has been turning higher. Headline inflation's at 2% target. You can see here in terms of the 3-month annualized, that divergence between the two. So that's a sort of different way of looking at it, to just take into account the more recent data. So more recently, we've been seeing an uptick in terms of core inflation, not necessarily headline inflation. Will that stifle the Bank of Canada? Well, markets at the moment are pricing one more rate cut from here on in. And so the fact of the matter is, if we do get to a point where the Bank of Canada stop easing, then perhaps we do see some strength come into play. Maybe it's the case that we see weak inflation data, and it provides the basis for markets to think that we're going to see, or weak retail sales, that we're going to see additional action taken from the Bank of Canada. Now, in terms of the Canadian dollar, what's interesting here is that we've been running higher against the euro of late. Let me just bring that up. We've been running higher against the euro, set within this sort of rising ascending triangle formation. You know, previously you could say that it's essentially a channel. Let's just look at that. And so you can view it in that perspective. But at the moment, we're sort of struggling with resistance here, 1609, 161 essentially. The wider context shows you that we're sort of breaking higher at the moment. So we're set within this sort of breakout phase, and now we're channeling higher. Do we see a breakout through resistance? If we do, then you'll be looking at trendline resistance, and then the possibility of it rolling over. And certainly if we do come out with a potential inflation report that sees yet more elevation in terms of core inflation, does that essentially start marking the end of the easing process for the Bank of Canada, and potentially providing strength for the Canadian dollar going forward? So key resistance is 161. Above that, we've got this ascending trend line, but ultimately we're trading within this rising channel formation. So it does point towards the potential for this market to roll over before too long. I hope that's been useful for you guys. To make sure to like, subscribe, follow for more. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and a great week trading. Thank you.